This is the optimal order for investing your money as a high-income earner. Let's jump right into it. So first of the first is to invest in yourself. This might sound cliche, but it's true. Consider educating yourself through courses or reading books on personal finance, and think it as building your own financial superpower. Alright, now let's talk about the foundations. I have two things in this category, and first is the emergency fund. We all know life throws curveballs, so let's be ready and aim for save 6 to 12 months of living expenses in an easy-to-access account. This is emergency fund that covers unexpected bills and job changes without having to stressing yourself out. I once tapped into my emergency fund at a very low point of my life, and it really helped me to bridge a period of time when I was making life changes. I felt lucky that I was putting this as a priority and never tap into that fund unless it's very necessary. So you never know when a rainy day will come, so always have an umbrella prepared. Second, high interest debt. Eliminate credit card debt and other type of high interest loans, which over 7%, I consider that as high interest loans, because they are significantly hindering your progress of building your wealth, and is also very mentally stressful. I would prioritize paying off this category if your cash flow permits, or consider debt consolidation with a lower interest rate option. Let's talk about the second category, maximize tax advantage accounts, as well as employee benefit accounts. Number one, employer match. Your employer 401k match is literally free money and often amounts to thousands of dollars each year, and prioritizing contributing enough to your plan to maximize this match is what I will prioritize. And it's essentially an immediate return on your investment for high income earners. And take an example, if your employer match 100% of the first 5,000 contribution, let's say, and that's an instant 100% ROI return on investment on your $5,000 investment. So don't miss out on that. ESPP, Employee Stock Purchase Plans. So some companies offer you the opportunity to buy the company stock at a discount up to a certain amount. Sometimes it's 5 to 15% less of the market value. So you contribute through your payroll deduction over a period of time and then receive the share at the purchase date. Because your purchase price is at a 5 to 15% discount, even if you sell it right away, you can profit from the difference. It's almost a form of saving with a 5 to 15% upside. You have the option to hold the company stock or sell it for cash or convert it into index fund to make sure you understand the pros and cons of each option when you make the conversion. Next, the 401k contribution. Beyond the match, take advantage of the significant tax-deferred growth offered by 401k plans. In 2024, you can contribute up to $23,000 if you're younger than 50 years old. If you're older than 50 years old, you can contribute up to $30,500. Next, DCFSA. If you have a young child, you should consider DCFA, which is like an FSA. You contribute pre-tax dollar to cover all the different sorts of dependent care expenses, including childcare, daycare, after-school program, and even adult daycare for elderly dependents. It reduces up to $5,000 tax-free. Also remember, like other FSAs, unused funds at the end of the year usually will disappear. So you should plan for your contribution and making sure you actually spend out that amount before the year end. Next, IRAs. Both Roth IRA and traditional IRA offers tax benefits but cater to different situations. Traditional IRA offers upfront tax deduction and tax-deferred growth, while Roth IRA lets you contribute growth tax-free and offer tax-free withdrawal in the retirement. So consider your current and future tax bracket to choose the right one for you. Next, the HSA, which is one of the only accounts we have talked about so far have triple tax benefits. If you have a high deductible health plan, you should take advantage of HSA. contributions are tax deductible, earnings growth are tax-free, and qualified medical expenses are withdrawn tax-free. It's a triple tax advantage for both present and in the future. Now let's talk about advanced strategies. Roth Mega Backdoor. If your employer offers this option, and you should definitely take advantage on that. This plan allows you to convert your after-tax 401k into after-tax Roth, and then you can convert it out to a regular Roth IRA. This allows you to further grow your Roth IRA account tax-free in terms of the growth, and for the withdrawal is also tax-free. And one key benefit for this option is it has a much higher limit in terms of the contribution and compared to your traditional regular Roth IRA. Next, Roth conversion. Planning is key here. Consider converting some of your traditional retirement savings into a Roth IRA during your low-income years. This lets your money grow tax-free and avoids future taxes when you are withdrawing during your retirement. While you will have to pay income tax on the converted amount, but the potential for tax-free growth in the long run can be significant, especially you're expected to be in a higher tax bracket while you're retiring. Make sure to consider your actual situation and make these changes during your low-income years. Next, the 529 plan. If you're already thinking and planning for your kids' future college, 529 plans are a fantastic option. Invest in your children's future college fund and education fund with a tax advantage growth and tax-free withdrawal for qualified expenses. Contributions often offer state tax deduction, and plans have a diverse investment options. Explore different types of 529 plans and comparing on the fees and features and what are your investment options, and to decide on which one fits your needs the best. Next, taxable investment accounts. Once you have maxed out all the retirement accounts, a taxable brokerage account is a great option for you to grow your net worth. Buying and selling stocks or index funds comes with tax implications. Short-term capital gain tax are applied to the profit from selling an asset you have held for less than a year. It's the same tax rate as how much you paid for your ordinary income, like your W-2 jobs. However, long-term capital gain tax is applied to assets held for more than 1 year, and long-term capital gain tax rates are from 0%, 15%, and 20%, depending on your income. Let's do an example here. Say someone makes $250,000 in a year, and the long-term capital gain for this person will be 15% as a single filing status. But the short-term gain for tax is going to be 35%, which is the same as their ordinary income. This is pretty big difference. So aim to hold the investment for over a year to benefit from this significant lower long-term capital gain tax. With a caveat, only if this is aligned with your investment strategy. Next, UTMA, which is a Uniform Transfers to Minors account. It is a brokerage account that are taxable investment accounts with no contribution limits. The first $18,000 for individual or $36,000 as married couple are free from gift tax. Up to $1,000 and $250 in the earnings from the custodian account are exempt from federal income tax. The earning beyond that amount will be taxed as a child's tax rate, which is generally lower than parents' tax rate. Things you need to know about UTMAs are you are giving up control once the funds are transferred, and you're locked in. You cannot get it back. The custodian, aka yourself, manage the account until the minor becomes an adult, turns after 18, and you can only use the fund for the minor's benefits, not everyday expenses. UTMA brokerage accounts that are considered assets owned by the child, which can impact the financial aid when they're applying for college. So before you start contributing, make sure you do your own research or consult with a professional to decide if UTMA aligns with your long-term goals. And I will link some resources down below. Next, alternative assets. If you have a higher risk tolerance and are looking for diversification beyond traditional investments, and consider alternative assets options like real estate, small business, angel investing, and even digital currencies can offer high potential returns but also carry significant amount of risks. Just make sure that you do your own research and fully understand the risks involved before you put your own hard-earned money into any type of investments. Low-interest debt. Let's not forget about low-interest debt. While this is not as urgent as high-interest debt, analyze each category and prioritize paying it off based on its impact on your cash flow and your overall financial goals. Eliminate those debts can help you free up more cash flow and having more money for the future to invest and achieving your long-term financial goals. So now let's summarize. Prioritize building your own financial knowledge, and then secure your foundations with an emergency fund and high-interest debt elimination, and maximize tax advantage accounts through your employer matches, ESPPs, 401ks, IRAs, and HSAs, as well as DCFSA. Consider advanced strategies like Mega Backdoor, Roth conversion, 529 plans, and utilize taxable accounts with long-term holdings. Understand UTMA and its limitations, assess the different alternative assets investment options, and manage your low-interest debt strategically. Always do your own research or consult a financial advisor if you're not sure about a certain topic. And finally, investing is a marathon, it's not a sprint, and we all need to be patient while we're on this journey. So thank you so much for watching, and subscribe and like this video before you go, and I'll hope to see you next time. Bye.